In May next year, the team at Argo Investments is going to be travelling to various capital cities as part of our National Investor Roadshow. It'll be our first in more than 3 years, and we're very much looking forward to meeting face-to-face with our shareholders. In the meantime, I'm joined by Jason Beddow, our Managing Director, who's going to discuss the current market conditions, how Argo invests in this climate, and the outlook for Australian shares. Jason, I want to start by asking you about the recent market volatility. We've seen precipitous falls and aggressive rallies, and I want to know what do you look for in this kind of environment as far as fundamentals? How do you approach markets in this climate?
It's a very good question. Look, it's pretty difficult at the moment. The volatility on a daily basis is certainly not fundamental. So I think you need to stick to, I guess, the fundamentals that you invest around. We're a long-term investor. We like security of good balance sheets, cash flows. So these businesses should be relatively resilient despite the volatility. But a daily share price at the moment is really a toss of a coin. As we recently said at the AGM, we haven't been investing a lot of new capital in the market. We think there may be better opportunities over the next few months. So we're working hard, I guess, to try and identify where we see value, but it is quite difficult.
And turning to the economy more broadly, there seem to be two distinct camps. Some people are decidedly pessimistic given a range of economic headwinds that appear to be facing the Australian and global economy, yet unemployment remains at near 50-year lows and retail trading figures seem quite resilient. What's your take, and what economic indicators are you most focusing on?
Well, I think unemployment, as you call it, is really crucial. Clearly inflation's high. Central banks, the RBA, are increasing rates. I mean, in an absolute sense, 2.6% is not outrageous, but we do think there's more rate hikes to come. And I think in an environment when unemployment's low, people have jobs and are spending, they can be more comfortable to maybe keep pushing on rates. So I think they will be clearly watching that as a turning point, maybe not to cut rates, but certainly maybe to stop putting rates up. So that's, I think, very, very key. And look, we don't really know what's going to happen short term. We've still got the US Fed to raise rates maybe 3 more times this year. We're expecting 2 more rate hikes from the RBA. So that gets us into calendar 23, and I think we need to wait till we see those rate hikes settle through to see if the numbers are still strong. Are people still spending, and is unemployment still low?
So it's perhaps not being reflected in the figures just yet, but you're speaking with companies every single day. They're at the coalface. What are they telling you from on the ground about inflation and interest rates? Are they starting to bite? Because retail trade figures, for example, tend to indicate that they're not.
No, I think you're right. The data is suggesting that thus far it hasn't really bitten. I think the consensus view, if I think about meetings we've had recently with bank boards, retail and other businesses, is everyone's expecting the data to soften. It's just a matter of when and how steep is the fall off in consumer spending, how fast do the savings fall. There's quite a lot of savings built up through COVID. And that's a good buffer, but when does that start to run out? And yes, I think the CBA put up a great slide from the first RBA rate hike to the impact of when a mortgage holder with them felt the impact. And there's a good, depending on the loan type you're in, could be 3 or 4 months. So the last rate hike that we've seen from the RBA in October probably won't really be impacted till early next year. So there's definitely a delay, but I would think most people are expecting some softening, but we don't know when or how far.
And households don't seem to be positioning themselves for that impact.
Well, I guess if you've got a job and you know that you can move to another job, surely the cost of living is going up and your discretionary spending might be, fall. But if you're confident you can have employment and maybe get a better job or a better paying job, you probably are more confident to spend. I mean, we see the travel numbers are bouncing back. People are flying, people are out in restaurants, holidays and services seem to have taken over from the goods spending through COVID. But it still seems pretty robust.
And do you think as well that the labour market with the labour market remaining so tight, can wages remain as stagnant as they've been over recent years?
Look, it's a good question. I think the US is a little different. The average wage is quite low. their numbers look even tighter with unemployment and participation. So I think wages increases in the US will continue for some time. Australia's a little different, but equally we are seeing some pent-up wage increases coming through. We have a lot of enterprise bargaining agreements that are staged over 2-3 years, so it'll be interesting to see what happens to those in, say, 2023 with some wage inflation behind that. Clearly the unions probably have a louder voice with the current government. We'll see how that plays out. But yeah, I think for a business that has their largest variable cost as labour, I think it will be a challenge to maintain margins in that environment.
And just turning offshore or looking offshore for a moment, and to Australia's largest trading partner being China, and that economy is facing a lot of headwinds, not least of all because of its commitment to a COVID zero policy. What are the impacts that Australian businesses and companies that you're investing in feeling as far as that slowdown goes, and particularly with the miners, which supply a lot of the raw materials for the Chinese economy?
Yeah, look, it's a fascinating relationship we have with China. They're our largest importer and export partner. Look, the numbers have been pretty soft in China. You're right, the zero COVID policy has had a material impact. A slowing Western world, if that's what happens into 2023, Europe, the US, will certainly dampen exports from China, and maybe commodity demand is not as strong as it was. Look, good quality resources will be in demand from China, notably iron ore from Australia, probably copper and other things. But we're a little cautious on China and just where they are geopolitically with level of alignment with Russia, perhaps buying a lot of Russian commodities, probably at relatively good prices. But that makes it just a little harder than normal from the period, I guess, when China joined, the global trade back in 20 years ago. And they've been a great facilitator of product into the Western world at discounted prices. We've seen the prices of most consumer goods fall, and equal to that, their commodity demand has gone through the roof. Well, I think we're at a juncture that may be about to change, even though I think the underlying commodity demand is still strong. So we're still comfortable with the big miners, but maybe their peak earnings is behind them for now.
Okay, and moving to another significant sector in the Australian market being the banks. What's your outlook for them in the current market, particularly with interest rates rising?
Yeah, look, we think the banks look relatively solid. I mean, clearly at the end of the day, they're a leveraged vehicle, that is going to behave, I guess, in a correlation to the economy. So if the economy is doing well, the banks do well, and conversely. But I guess in this cycle, the banks have got fantastic balance sheets. They've got rid of a lot of businesses that were wealth management, insurance, really non-returning businesses. They've returned a lot of capital to shareholders, and we expect their dividends to be sound. This first phase of the tightening cycle should be positive for their margins, so they should actually be earning more on their loan book. Equally though, it's pretty competitive out there now that they're all chasing good mortgages or good individuals and good businesses. So we imagine the front end of the book's going to be increasingly competitive. And equally, the Royal Commission's not that far away that we think they're going to have to be fair on deposit pricing. So I don't think they're going to be able to gouge, as in put rates up on all their mortgage products and business lending and not pass some through on deposit products, which will equally be competitive. So I think this period should be very good for banks. We saw BOQ recently, Bank of Queensland, just in a sort of, a stylistic of what the banks will report, had margin compression, NIM expansion, which was good. And I expect the banks that report shortly will equally have pretty solid results.
So a positive climate overall for banks currently. Where else in the market are you seeing value?
Look, there's a lot of value. I guess it's more the uncertainty as to how things look next year, and there's a really wide dispersion of views on how high interest rates go, how long does inflation hang around, and even, I guess, to the extent, does Europe have a bad winter or a recession? Does it flow into the US? So look, I don't think it's particularly easy. We think commodities are still, there's been a lack of investment, there's a lot of demand, so those businesses should be quite good. In particular, lithium, anything to do with, I guess, the new world, new commodities. Supply will catch up, but for the moment, there's a real supply shortage, and I guess customers are almost willing to lock in any price to lock in volumes and demand. So we're fairly constructive on commodities. Energy, we think, is still, there's clearly, as we recently just mentioned, energy security is now probably more important, or at least thought about, that hadn't been thought about for a while. So we think, LNG, and gas is clearly part of the solution, I guess, or the transition into renewables. A lot of investors, a lot of governments around the world have, stepped back from saying, well, gas is not part of the equation to, that we need gas. Australia is pretty well positioned. So they're probably the ones we have most confidence in because the cash flows are great and the balance sheets are good, cash flows are great, and we're happy to bank that. Some of the other businesses, I think it's a little hard to call and have a lot of conviction in just where they go in the short term.
Okay, and looking ahead, what do you expect for markets and what will be shaping markets for, say, the next 6-12 months?
I think it comes back to inflation. If inflation stays stubborn, particularly offshore, Europe looks pretty onerous with some of the energy cost increases, and the US, and they continue to raise rates beyond where the markets think, that's clearly a headwind for equities. And if the US sneezes, we often say, the rest of the world catches a cold. So I don't think we'll know until probably end of the first quarter, and then the US will raise rates potentially 3 more times this calendar year. They don't have a meeting in January. So we then get to February. If inflation's still stubbornly 4 or 5% and they have to increase rates again, I'm not sure that's priced into the market. There still seems to be, and we're watching it as well, a lot of the view that once central banks get to the peak of their interest rate increases, not that it will be imminent, but the next move will be down, and equities generally perform well. So people are looking for that tipping point. I guess my gut feel is that might be a little bit further out than I think some people are thinking.
Great. Thanks very much for your time, Jason.
Thanks, Meredith.